Welcome to the deep dive. Imagine leaving, well, significant money on the table without even realizing it. Simply because a few key lines on your partnership's tax return weren't fully grasped.
It happens more than you'd think.
Today, we're taking a deep dive into the, often misunderstood world of U.S. partnership taxation, specifically Form 1065, your U.S. return of partnership income.
Right.
Our mission, to pull out those critical nuggets that help you understand how getting the reporting right isn't just about compliance. It can genuinely maximize your tax benefits as a partner.
Exactly. We're looking at this, like a practitioner would. And what's really insightful is how moving beyond just checking the boxes can unlock some serious tax planning potential for you. It's about understanding the why behind the rules, not just the what.
Okay, so let's kick things off with what makes a U.S. partnership unique, that pass-through status. What exactly does that mean? How does it change the game compared to, say, a corporation?
Great question. So unlike a C Corp, the partnership itself generally doesn't pay federal income tax.
No entity-level tax.
Right. Instead, it acts more like an information pipeline. The income, gains, losses, deductions, they all pass through directly to each partner's individual tax return. Form 1040. This means you are taxed on your distributive share of that income. And here's the kicker. It doesn't matter if the partnership actually distributed any cash to you.
So this is where that phantom income idea comes in, right?
Well, so that's
surprises a lot of partners.
Oh, absolutely. You owe tax on income you haven't necessarily, pocketed yet.
Right.
And this phantom income isn't just some weird quirk. It's actually a critical trigger for tax planning. It forces you to think about cash flow even if profits aren't being paid out.
And the document that tells you your share is?
That's the Schedule K-1. It's the crucial piece that communicates your specific slice of the partnership's results.
Fascinating. Okay, this brings us to another really foundational concept, one that acts as a real gatekeeper for partners' basis. Can you break down what a partner's outside basis is and why it's so vital for your tax situation?
Absolutely. Think of your outside basis as your cumulative after-tax investment in that partnership. It's like your personal tax ledger for your partnership interests.
Okay, like a running total.
Exactly.
Yeah.
It tracks everything from your initial contributions, your share of the income, even your share of the partnership's debts. But what's really crucial here is how basis limits things.
Limits what?
Well, for one, your loss deductions. If your share of the partnership's losses is more than your basis, those extra losses are suspended. You can't deduct them that year.
So you could have a real economic loss, but get no immediate tax benefit.
Precisely. They're stuck, sometimes for years, until you generate more basis, maybe through future income or contributions.
Wow. What else?
Cash distributions. This catches people out too. Cash distributions from the partnership are generally tax-free only up to the amount of your basis.
Only up to basis.
Correct. And here's another wrinkle many partners overlook. Non-deductible expenses. Things like fines or that 50% of business meals that isn't deductible, they actually decrease your basis.
Really? Even though they weren't deductible?
Yes. So they can quietly eat away at your ability to take tax-free distributions later. On the flip side, things like your contributions, your share of income, including tax-exempt income, importantly, and your share of partnership liabilities, those all increase your basis.
Okay, so we have pass-through, phantom income, basis.
Yeah.
Understanding these pieces is key. How does that translate into maximizing your actual tangible tax benefits as a partner?
Well, the real unlock here is understanding the difference between ordinary business income and what the tax code calls separately stated items.
Separately stated.
Yeah. Ordinary income is basically the partnership's general profit or loss from its main business. Pretty straightforward. But the tax code, specifically Internal Revenue Code Section 702A, requires certain other items to be pulled out and reported separately on the K-1.
Why separate them?
Because it preserves their unique tax character for you, the partner. They don't just get blended into one big number.
Okay, give us an example of how that helps.
Sure. Think about long-term capital gains. If those were just mixed into ordinary income, you'd pay tax at your regular, potentially higher ordinary income rate. But because they're separately stated, you get to apply the preferential individual capital gains tax rates, 0%, 15%, maybe 20%. That can be a huge difference.
Makes sense. Any other big ones?
Definitely. Section 179 deduction is another great example. This lets businesses immediately expense the cost of certain property up to a pretty high limit.
Instead of depreciating it over time.
Exactly. By separately stating this, it ensures you as the partner can potentially maximize that immediate deduction on your own return, rather than it just slightly reducing the partnership's overall ordinary income figure. Gives you more direct control and benefit.
So all these potential benefits, these character distinctions, they really hinge on accuracy then. It sounds like Form 1065 isn't just a form, it's interconnected with Schedules L, M1, M2, like a closed system.
It absolutely is. It's designed to be a self-reconciling system. Schedule L is basically the balance sheet assets, liabilities, capital.
Right.
Then Schedule M1 reconciles the partnership's book income, like from its accounting software to its taxable income. And Schedule M2 tracks the changes in each partner's capital account on the books. They all have to tie together.
So discrepancies, those flags, tax software sometimes throws up?
They aren't just warnings to ignore. They signal a potential breakdown in that system. Resolving them isn't just about clearing an alert. It's about digging in and verifying against the underlying accounting data.
What kind of things cause imbalances?
Oh, lots of things. But a common one, say for an out-of-balance Schedule M2, might be unrecorded non-deductible expenses. Or maybe tax-exempt income wasn't tracked properly. Those are classic book tax differences.
And fixing those isn't just administrative.
Not at all. Fixing them ensures your basis calculation is correct. It makes sure your losses aren't being suspended when they shouldn't be. It ensures you're actually getting the tax-free distributions you're entitled to. It's fundamental to getting the benefits we've been talking about.
So ultimately, really mastering these foundational principles basis, separately stated items, and the art of reconciliation, it transforms this potentially dry tax form into something more.
Exactly. It becomes a dynamic tool for maximizing your after-tax returns.
The accurate data that comes out of a well-prepared Form 1065, your basis number, any suspended losses you might have, understanding those book tax differences.
Yeah, that information becomes absolutely vital. It feeds directly into your future strategic decisions as a partner, planning cash flow, timing investments, structuring deals.
It all connects back. Okay, a final thought then for you listening. How might understanding your own partnership's tax reporting, really getting into the details of that K-1 and how it's put together, better empower your personal financial planning and maybe your future investment choices, especially thinking about cash flow versus tax liability, something to chew on.